morning market wrap. An interesting night last night. Traders could have taken that Chinese CPI data yesterday. CPI down at 1.3%, lowest in 5 months, and PPI down at negative 5.9%, continuing 44 months of falls in producer prices in China. They could have taken that and run with it. But the first signs that perhaps, some support was coming into stocks and that they were going to ignore the Chinese data came in on the ASX yesterday, which rallied from a low of 50.47 and closed at 50.99. That was a pretty good performance, all things considered. Most of the day, it had been sitting around that 58 points down that the futures had indicated before that rally in the last couple of hours. That's allowed it to hold important support in a technical basis, which is good for the structure of the market. And it's also that level that I talked about a few days back. I wrote on AxiTrader back on Monday with the chart of the day, which was the SPY 200, that I thought a move to 50.60 was probably reasonable, but a move through there just at the moment probably not quite the case. And I guess that's what we're seeing. The Aussie market's under pressure, but unless or until the S&P goes a little bit lower and breaks that sort of that 260, 270 support zone, 2060, 2070 support zone that we see in the S&P 500, then the Aussie market can hold in. What's interesting about the Aussie market, though, and I'd encourage you to have a look at either my AxiTrader morning report or my Business Insider morning report, depending on where you read, and have a look at the piece that I've linked by David Scutt, which talks about the inability of Australia's major banks to continue to do the sort of dividend policy payout ratios that they have. There's a number of reasons for that, but the key is that those banks make up a huge percentage of the indexes, and as a result, if we do start to see some valuation effects in the share price, that will drag the ASX lower, because I don't think it's priced in when it comes to a retail point of view. So, at the end of a close of business, the Dow was up a smidge, the S&P was up a smidge, recovered off its low, the NASDAQ was down. In London, the FTSE continues to struggle. The DAX was up again, but it still can't get through that support. Most of the action, of course, was on foreign exchange markets. And the euro pumped down under 107 last night, but it's back up at 107.21. Realistically, these aren't great big moves intraday or intra-week just at the moment. So the fact that the Aussie rested back on the weekly lows is no big deal. But from a euro point of view, from a US dollar point of view, people seem to be focusing on the fact that we do have completely divergent outlooks for the economy and for interest rates. Now that, of course, happens to favour the US dollar pretty much exclusively amongst all other countries. The CPI data in China yesterday suggests more PBOC easing, both of the reserve rate requirement, which can put a flood of money into the market, and also on interest rates, which are pretty low anyway, in the sort of a 375 region. But the ECB is looking at, moving rates deeply into negative, QE coming out, even though Jens Wiedemann, the Bundesbank president, said that rates can't stay, accommodative forever. The forex market ignored that, and that's what's favouring the US dollar at the moment. In terms of technical outlook, the euro. Let's just go and have a look at the chart, and I'll talk you through it. So here's my euro chart. You can see in this chart, if I blow it up a little bit. So you can see here that we've had a nice long candle. That potentially is the bottom last night with that move lower. What was the actual low? The actual low is 106.70 odd. In terms, that's the weakest we've seen since the recovery back in April, March. So it's a 6-month low. And you can see that, we've got the MACD histogram pretty wide. We've got a nice long tail, and we could see euro. Now, if euro got back up through 107.60, something like that, it might be an indication that the bottom is in. But my system hasn't yet signaled that it's buy time. So waiting, watching, but not jumping in because I don't want to catch a falling knife. If I go back to the Aussie, which we mentioned earlier, still in this downtrend, got support in the 69.80, 69.90 region. It hasn't done anything all week. You know, it's had a 60, 70 point range. You know, that's not a lot for an Aussie. If you look at a weekly 14-day average true range, you've got 200 points. So maybe something's going to give. You know, we're well over 100 down on what the Aussie does normally. But yeah, you should see support down here at the 69, 80, 90 region. But overall, it continues to be in a downtrend. I think that the NAB business survey yesterday, what it did was it highlighted that why the RBA has got an easing bias. You know, business conditions are strong, but business confidence is down. And when you look at the breakup and we're starting to see complaints from business about the Aussie dollar and the lack of pricing power or ability to pass on higher prices that result from the Aussie dollar, that tells you the economy's not as strong as maybe I thought it was in the past. So something to keep an eye on anyway from an Australian dollar point of view. If we go back to the S&P, the Aussie market, here we go. You can see that it dipped down through but closed above. So that on a daily basis, that level has held. It's not overdone on the downside by any stretch of my, normal system, and I'm not convinced that the low is in just yet. But I think whilst yesterday's low 4 terms, I think it was 34 or 38. You can probably see some consolidation. But I guess for me, the key thing is that I really do think when you look at the S&P that this is a topping pattern. Now, you can draw a nice line there. Let's do that now. Let's just draw a line across here. Oops. Well, you can see what I'm trying to do anyway. I'm trying to draw a line across there. So let's say if the night before last low gets taken out, 2060, which was the zone we talked about last week as support. If 2060 gets taken out, then the S&P is going lower. That is my bias. I believe, based on my system, that when I look at it, it is going to test back to the bottom of the old trading band, which is 2045, 2044. If it got through there, then it would look wobbly. But for the moment, it looks like, to me, it needs to go below. Of course, it's Veterans Day in the US tonight, so it's an important holiday for them. I mentioned again about the DAX. The DAX, you'll see through time how I use my moving averages. They're fantastic. DAX came down, found support at my fast moving average, rallied off. To be frank, I have no idea why that works. It makes no sense to me that a market should consistently, over multiple time frames, find support or resistance, depending on which way the market's moving, at my fast moving average. But it's the system I trade, and it works. I don't understand it. I truly don't. It's one of those things. That happens in trading. You get some things that work, are difficult to explain, and constantly watch them and monitor them and check the performance and that kind of stuff. Anyway, that's probably a good place to stop. It should be a quieter day today, although we've got some massive Chinese data. The Chinese data out today is industrial production, retail sales. I'm having a mental blank here. Retail sales, industrial production, urban investment. They're the big three behind CPI and GDP. So they're vitally important to traders. Look out for what they say. To give you a guide for what to look for. Oops, sorry. I've just got to look over here on my other screen. The market's looking for 10.9% year-on-year growth for retail sales. It's looking for 5.8% year-on-year growth in industrial production. And it's looking for 10.2% growth in urban investment. So they're the levels to watch. Anyway, that's it from me today. Have a great day, And you can find me on Twitter, as always, at Gregory McKenna. You can find me at Business Insider. You can find me at gregmckenna.com. And of course, I'm now writing for and working with AxiTrader as a strategist there as well. Not everything I do ends up on all three platforms, obviously. Different masters, different hats, different audiences. So a more trading bent is either my website or AxiTrader. More informational bent, and none of it's advice, obviously. More informational bent Business Insider. Have a great day, and I'll catch you tomorrow morning. Bye for now.